Most traders don't lose money because they can't read charts or don't understand indicators. They lose money because they fall in love with the fantasy of a big win. One trade that changes everything. One position that finally proves they were right. One moment where the market stops ignoring them and rewards them all at once. This fantasy is powerful because it feels logical. If one big win can fix everything, why bother with small ones? The market understands this mindset very well, and it uses it against traders every single day. Early in almost every trading journey, there's a defining moment. A trade that works far better than it should. Maybe it's an options trade that doubles overnight. Maybe it's a leveraged futures position that catches a sudden breakout. The profit feels unreal. The heart rate spikes. The body tenses. Dopamine floods the brain, and without realizing it, the trader's nervous system learns a dangerous lesson. This is what success feels like. This is what I should be chasing. From that point forward, the trader is no longer trading the market. They are trading their own memory. Small profits start to feel meaningless. A clean $10 win feels like nothing. A disciplined $50 trade feels slow and boring. Even a perfectly executed setup feels disappointing if it doesn't explode into something dramatic. The trader doesn't consciously reject small wins, but emotionally they stop respecting them. And when respect disappears, discipline soon follows. This is where most accounts quietly start bleeding. The market doesn't reward excitement. It rewards consistency. And consistency is not built through moments of brilliance. It is built through repetition, through doing the same small, correct thing again and again, even when it feels unsatisfying. Picture two traders starting with identical accounts. Same capital, same market, same day. Trader awaits for the big move. He wants one trade that matters. When he enters, he sizes aggressively because he believes conviction should be rewarded. Trader B trades smaller size, smaller targets, smaller expectations. His trades look unimpressive, almost boring. On the first week, Trader A hits a big win. His account jumps. He feels validated. Trader B finishes green, but barely. Nothing exciting. No emotional high. What happens next is not about strategy. It's about psychology. Trader A's nervous system recalibrates. That big win becomes the new standard. Subconsciously, he now expects the market to deliver that feeling again. When it doesn't, frustration creeps in. He holds trades longer, hoping they turn into something bigger. He skips exits. He sizes up earlier. His rules start to bend, just slightly at first. Trader B never experiences that shift. His wins are too small to rewire his expectations. There's no emotional addiction forming. Each trade feels like routine work. Enter, manage, exit, move on. That emotional neutrality becomes his invisible edge. Small profits don't stimulate the brain. That's precisely why they work. The human brain is wired to chase rewards, not processes. Big wins trigger dopamine spikes that temporarily shut down rational thinking. When dopamine floods the system, risk feels smaller than it actually is. Confidence inflates. The trader starts believing they see patterns others don't. This is not confidence. It's chemical distortion. Small profits don't create that distortion. Dopamine stays stable. Cortisol stays low. The thinking brain remains in control. Decisions stay measured. Risk stays visible. This is biology, not motivation. Casinos understand this better than most traders. They don't want players to win too big too fast. Big wins make people reckless. Small wins keep people engaged and controlled. Markets operate under the same psychological laws. That's why many traders destroy accounts right after their biggest wins, not after their biggest losses. A big win convinces them they've leveled up. They take more risk. They loosen rules. Exposure increases. And eventually, volatility arrives to collect. Small profits rarely trigger the chain reaction. There's another truth traders struggle to accept. Big wins usually demand big risk. And big risk compresses time. It creates urgency. The trade must work now or stress enters. When stress enters, objectivity leaves. The trader stops managing risk and starts negotiating with hope. Small profits don't require urgency. They allow patience. They allow exits to be planned instead of prayed for. They give the trader room to be wrong without emotional or financial collapse. Consider this carefully. A trader who targets small, consistent profits can be wrong many times and still survive. A trader who needs big wins cannot afford even a few mistakes. That fragility matters more than intelligence, strategy, or market knowledge. Wealth is not built by being right. It's built by not being destroyed. Small profits create antifragility. They allow mistakes without devastation. They turn losses into manageable events instead of account-ending disasters. Most traders misunderstand compounding. They believe compounding requires large gains. It doesn't. Compounding requires survival. You can't compound if you keep resetting to zero. A trader making 1% consistently will outperform a trader chasing 10% occasionally if the second trader keeps blowing up. The market doesn't reward ambition. It rewards restraint. Small profits train discipline. They reinforce respect for risk. They shift focus from prediction to exposure management. Over time, these habits quietly build wealth. Not dramatic wealth, not overnight success, but durable, repeatable wealth. And here's the part most traders resist. Small profits feel boring because they don't feed the ego. There's no screenshot, no story, no moment of glory. You don't feel special. You just do your job. That boredom is not a weakness. It's the signal you're operating correctly. Professional traders don't seek excitement. They seek repeatability. They don't care how impressive a trade looks. They care whether it fits a system they can execute thousands of times without emotional damage. Big wins are loud. Small profits are quiet. But quiet things endure. If you study traders who survive multiple market cycles, you'll notice something uncomfortable. Their equity curves are smooth. Their trades are unremarkable. Their edge is not intelligence or prediction. It's restraint. They understand something most traders never fully accept. The goal of trading is not to win big. The goal is to stay consistent long enough that winning becomes unavoidable. If this way of thinking challenged you, let it sit. Discomfort often means growth. If you want more calm, psychology-driven trading insights that help you survive and stay consistent, subscribe to *** Profit Pulse ***. Like this video if it shifted how you see profits, share it with a trader still chasing big wins, and watch the next video waiting for you. Because in the market, the quiet edge is the one that lasts.